So whether it's Biden or whether it's Trump or whether it's the credit markets, we're going to deal with this, and we're going to go through a period of a slower economic growth, which is exactly what history tells us we should be going through. The credit markets will revolt, and we have a 1987 crisis on our hands. And that is the significant tail risk that investors need to deal with going into 25 and into 26.
Jim Thorne, Chief Market Strategist of Wellington-Altus Private Wealth, returns to the show. Last time he was on the show, you can check out that interview in the link down below us. Up here, he was calling for a perilous financial collapse if certain conditions in the economy are met. We're going to revisit that call. You wrote that, and I'll just read a paragraph from your article here. The global economy is on the brink of a perilous financial collapse, and the lack of curiosity about the true risks has allowed a dangerous situation to fester. The facade of stability is deceptive. A strong headline gross domestic product numbers, job growth data, and declining inflation figures mask an imminent financial crisis fueled by excessive government spending and restrictive credit conditions. Jim, welcome back to the show.
Thanks for having me, David.
You're telling me offline that this debt issue is probably going to be the trigger for the next collapse. Let's talk about that.
I think the credit markets are going to push back. I think what we want to do is look at what happened to Liz Truss in the United Kingdom when she tried to implement a Bidenist type monetary fiscal policy, and how the credit markets pushed back. And she had a very short tenure and as prime minister. And so what I'm thinking is, it's not about the election. It's about what happens in 25. I think it's becoming clear to everybody globally that the fiscal policy and the fiscal situation in the United States needs to be dealt with. And either the politicians deal with it or the credit markets will force them to deal with it. And David, this feels a lot like 1987. And what I suggest to you is that when the markets lose faith in the credibility of policymakers and central bankers to control the situation, a significant market dislocation happens. And that's exactly what happened in hindsight in 1987. And I would suggest to you, if President Biden gets in and he implements the same strategy and policies, the same extreme far right-wing policies, that the credit markets will revolt, and we have a 1987 crisis on our hands. And that is the significant tail risk that investors need to deal with going into 25 and into 26.
Okay, so tax policies in response to this credit issue. Supposedly, we need to raise taxes if we're going to fight or pay back the bills on the Treasury debts that we have. Or the interest payments on this debt now surpassed $1 trillion on federal debt, as you know. This is what Trump said during the debate with Biden.
The only thing he was right about is I gave you the largest tax cut in history. I also gave you the largest regulation cut in history. That's why we had all the jobs. And the jobs went down and then they bounced back, and he's taking credit for bounce back jobs. You can't do that. He also said he inherited 9% inflation. No, he inherited almost no inflation, and it stayed that way for 14 months. And then it blew up under his leadership because they spent money like a bunch of people that didn't know what they were doing, and they don't know what they were doing. It was probably the worst administration in history.
Okay, lots to unpack there. What's your response? First, tax cuts. Are they the appropriate measure right now during our ballooning debt bubble situation?
No. And I think that's where Mr. Trump and where I get concerned is the fact that the policies that he implemented pre-COVID are not the policies that the credit market want post-COVID. And what are we using as our reference point? Liz Truss tried that and it didn't work. And there was a significant credit event in the United Kingdom and in the City of London. So I would suggest that he needs to be much more centrist in his policies. He cannot implement his policies with a cabinet that is populated with extreme right-wing economists, right? We need some adults in the room. We need some centrist thinking in the room. David, the era of extreme left-wing and, the left-wing redistribution of policies and the extreme right-wing trickle-down economics is over. We need a calm, thoughtful, provocative process to move forward that deals with the debt, that and allows the private sector to grow. And what I heard last night in the debate was not that from Mr. Trump. That is a risk. That is a significant tail risk. And we need to see, if he is the president-elect, what he actually does. And I would say to you, if we were managing money together, I would say if he populates his cabinet with extreme right-wing economists, then we need to take and put a significant non-zero probability on a tail event happening in late 25 and early 26. And David, it will be significant.
Before we continue with the interview, I want to tell you about a very serious risk, personal injury. Have you ever been seriously injured and wondered if you could get compensation? Now imagine if your injury or case could be worth millions. For example, Uber Eats driver Melissa Melvin won an $8.2 million verdict after her IHOP injury, as her lawyers were able to show the lasting impacts of her injuries and how significant those impacts were. Dealing with injury law firms, though, can be a nightmare. The endless paperwork and the high costs, it is overwhelming. That's where today's sponsor, Morgan & Morgan, comes into play. With over 1,000 attorneys, they have achieved significant verdicts for their clients. Just recently, they've also secured $12 million in Florida, 34 times the highest insurance offer. They don't settle for lowball offers. They fight to get you the money you deserve. What sets Morgan & Morgan apart from traditional law firms is that they have modernized the injury law process so that you can submit a claim directly from your smartphone. And the best part, their services are absolutely free unless you win. You can start your claim now with Morgan & Morgan at the link down below, www.forthepeople.com/David, found in the description, or by scanning the QR code on the screen. Let's assume Trump returns to the office. Let's assume that he cuts taxes for corporations and individuals. Let's assume he also raises tariffs to cover for these tax cuts. What's going to happen to corporate earnings?
I think you're going to have a correction in the stock market, and I think earnings are going to start to go down.
Even if corporate tax rates go down?
Yes, I think I honestly think that right now, I mean, the question I have for you is the thing that he needs to do is does he allow his tax cuts to roll off and then tax cuts go up and revenue comes to the government, or does he push that forward? If he continues and pushes his tax policy out and makes it permanent, there's really not going to be a significant jolt to the earnings, right? And so what I would say to you is there's going to be an area of the market, which is AI and innovation, that is going to grow irrespective of the taxes, right? Because the growth is so strong. And the market is going to get narrower and narrower and narrower. So I would just hope that Mr. Trump would get somebody in his cabinet which would provocatively think about the fact that the golf course that he's playing on, to use a golf analogy, because Mr. Trump seems to like using golf analogies, is not the same as before COVID. And I think if he does implement the same strategy, the credit markets are going to revolt.
The cost of living has been going up in America. This is an issue. Well, in Canada as well, but let's talk about America. What could be done to bring inflation back down towards the Fed's 2% target?
I think, so first off, let's separate price level from price change, right? I don't think the price level is going to go down, right? So, it might start to go down over a period of time. What we're starting to see right now, even with the PCE that came out today, is look, the Fed is over its skis. They got head faked out by the typical seasonal strength in CPI in the first 3 months of this year. Inflation is going to go back down to target, right? Interest rates are going to go below 2%. It will be very interesting to see what companies do in response to that to maintain market share. McDonald's is coming out with a $5 meal. Look at the earnings of Nike that came out overnight. Nike today is getting smoked. Walgreens is getting hammered. Levi Strauss misses. General Mills comes out. So you've got a period of readjustment for companies that raised prices too much through the COVID, they're going to have to start to bring prices down. But it's going to happen over the decade. And it's going to happen because these companies are going to have to cut prices to defend market share, which leads us to a deflationary environment.
So the cost of living crisis that we had it's over, is what you're saying.
It's not going up, but it's going to take a long time for the glide path to come down. Right. So that means consumption in the private sector is going to be less than people think. So, David, when we were talking, the economic growth that you and I are experiencing is a mirage, right? When we look at the GDP number that came out yesterday in the United States, it was all government spending, right? So if we go through this fiscal consolidation period, then economic growth and it looks more like the late 1940s or the early 1920s, where we get a growth shock, right? Where, you go from a deficit of 7% to a deficit under 3%. The private sector is already buckling. And this is the conversation that I have where I disagree with Wall Street. GDP is not the right variable during this cycle to measure economic growth because it is tainted with the sugar high of Joe Biden's excessive progressive fiscal policies, where debt to GDP is at World War II levels and deficits are at 7%. The IMF, the World Bank, the Financial Times, even the economists, you're getting centrist institutions basically saying enough already. That is the elephant in the room. So whether it's Biden or whether it's Trump or whether it's the credit markets, we're going to deal with this, and we're going to go through a period of a slower economic growth, which is exactly what history tells us we should be going through.
Let's get to the bottom of inflation. What caused inflation? There was a lot of finger pointing last night at the debate. This is Biden's response to Trump.
There was no inflation when I became president. You know why? The economy was flat on its back. 50% unemployment. He decimated the economy. This guy has increased your taxes because of the deficit, number one. He's increased inflation because of the debacle he left after the way he handled the pandemic. And he finds himself in a position where he now wants to tax you more by putting a 10% tariff on everything that comes into the United States of America.
The data suggests that Mr. Trump and Mr. Biden are equally responsible for the debt that we have. So they are not, both of them are not fiscally responsible. Let's just put that there and let's move that over to the side. So look at so the initial inflation was caused by two shocks, right? COVID and war. Okay. And it was caused by the Fed using Section 13.3, creating $4.5 to $5 trillion out of thin air, giving it to the Treasury. They became subordinate to the Treasury. The Treasury basically spent money. David, you couldn't go out and work. We gave you money. You sat at home. You spent money, but the prices went up because the supply chains were closed, right? And stopped. So that was the inflation, okay? And then what happens is this. Then what happens is 21 happens, late 21 happens. We should be coming out of COVID. And then the money that was left over, Joe Biden and Nancy Pelosi used it to implement extreme progressive left policies, which are inflationary. So everybody is responsible for the inflation, right? I would suggest to you that the central bankers are between a rock and a hard place because they did the right thing to save the economy through COVID, and then they basically got hung out to dry by the politicians, okay? And so if you ask me what they're doing, and Powell said this last December, he was very, central bankers very rarely speak overtly about folks in power. And both Jay Powell in the United States and Tiff Macklin in the Bank of Canada pointed fingers at Ottawa and Washington, D.C., saying that their fiscal policies were extremely inflationary. That is unprecedented, right? So this last tranche was basically caused by Washington and by Ottawa. So I understand why they are high, why the rates are higher for longer. I understand why Powell and the Fed are anchoring off of the most lagging data in the price set, which is, Supercorp services and owner's equivalent rent. But having said that, that by definition bakes in the cake that they are late, that they've made a policy mistake. And we know up here in Canada, Macklin went on the record talking to the CBC saying that lags up here are 18 months. The US is less interest rate sensitive than Canada. So the lags in the United States are going to be, or let's say they're 2 years, right? The Fed has to uninvert the yield curve and then wait 2 years for it to kick in. That's why, David, that's why we're going below 2. I know a lot of people say Powell wants to go to 2.5% and he's never going to change. Well, look, the policy mistake is baked in the cake. You go from 7% deficits to 2% deficits, you are going to have a growth scare. You are going to have deflation. And the last thing I would say to you, do you know who I got this analog off of? It was a presentation by Ben Bernanke a decade and a half ago at the Brookings Institution. They know this, David, right? They know this. That's where we're going. Now, we could argue what 27 looks like. You understand? Which is going to be completely different. But we are dealing with the echo of a post-war fiscal policy stimulus. And so when you look at the 20s, we had the depression that the world forgot about. And it was Benjamin Strong, the president of the New York Fed, that implemented and invented open market operations by the Federal Reserve. And that was the impetus for the roaring 20s. And you had the same thing in the late 1940s. They got freaked out because they thought they were going to go back to the Depression years of the 1930s. They basically cut rates. They stopped quantitative easing. They didn't touch the balance sheet of the Fed until when? 2008. We had fiscal dominance. And what did they do? They had inflation just above interest rates, and they grew their way out of it. David, that's how we get out of this. The only other alternative, which is door number 2, is the Austrian solution. The Austrian school solution, which is blow this thing up sky high and start from the beginning. I just don't think that's going to happen.
What does that mean?
Beg your pardon?
What does that mean, Jim? Blow what up sky high?
You have to basically have a debt jubilee and write all the debt off.
Okay.
Right. And that's when you hear the Austrian school economists or the newsletter writers, they're giving you the von Mises solution, which is you've got to basically blow the system up again, blow it all up and start from the get-go and have zero debt. That's basically it.
Okay. So the stimulus was partly responsible for the inflation and the Fed acted too late. And now you're saying it's too late to cut. You tweeted this before, not too long ago, earlier in the month. Old rule, the Fed funds rate should equal the real yield on the 10-year. According to that rule, we have over 3.25% in cuts in front of us. FFR equals 5.375. Okay, so first, lots to unpack there. Are you suggesting?
Well, so what I typically do is I want to use, the policymakers' views. We've got two converging views, right? We have the head of the New York Fed, the president of the New York Fed has a view of what the natural rate of interest is, or the neutral rate of interest, R star, Mr. Williams, a very smart man. And that New York Fed model says R star is about 75 basis points. It's actually declining. And I know that if you talk to some of your guests that are very close to Lacey Hunt, that is his view, that because of the debt, because of demographics, because of innovation, R star has been declining for decades, right? So that's one. And that says that the Fed funds rate, if you're using that theory that was developed by Newt Wicksell, that the Fed funds rate's got to get below R star for it to be loose. Okay, so there is a view, I would suggest to you, like from Lacey Hunt and others, that you got to get the zero bound is basically in play. And then let's listen to what Mr. Waller says. Another very smart man that works on the Fed. I think he's probably one of the smartest men on the Fed, and he's really driving the intellectual conversation there. He came out with a very provocative speech a couple of months ago, and he basically said, I think our star is the real rate on the 10-year, right? And if you do that, you get somewhere between let's say 2.5%. So we have massive rate cuts. Yes. When I sit there and say to you, there are people freaking out about 25 basis point cuts. And if you have a lag of 2 years, Dave, we need to get significant cuts in the system. And then we need time. So they were late in hiking. They're late in cutting. And you're going to be surprised at how low the rates go and how bad the private sector growth is going to be through this adjustment period.
Okay, my only pushback to this is the Fed funds rate has been above our star in your case, the real 10-year yield of 3.25 for a while now. And look, no hard landing yet, right?
And so the question comes, what this era is different from any other era since World War II is we're dealing with excessive fiscal policy that is keeping GDP higher and thus giving a false sense of security that economic growth is stronger than it is. So if we strip out public sector spending and public sector spending goes back to its normal levels, what does GDP look like? And I would suggest to you, we're going to go between 25 and 26 as we adjust fiscal policy and the deficit back to normal levels. We are going to have a growth scare. And the question is, can you hide out in these AI names and crypto? Can you hide out in these secular growth names? Or even a worst case scenario, the individuals in power do not implement a strategy that the credit markets have confidence in, and then we have a tantrum within the credit markets, which really affects all risk assets, and we have a significant correction. That is what's in front of us.
So the yield curve, I'll talk about the significant correction just a bit. The yield curve has already been inverted ever since 2023. Is it too late, Jim, to avert or avoid a recession? Can the Fed do anything at this point to sustain this soft landing?
History says no. I would suggest to you it might be a unique time in history because of the innovation that's happening in the United States. So I will qualify this. I think the United States has a shot at a soft landing. I think other Western countries don't. Because once everybody starts getting through this fiscal, look what happened to Europe when we did the austerity.
Already had a recession. You're right. You've already, the Canada, the Eurozone, all technical recessions. The only country that hasn't had a technical recession yet is the U.S. But yeah, please continue.
Yes, and so what does it look like? Can AI and the growth that's caused by the secular growth area in the United States? Can it generate enough growth? And will the Fed cut rates fast enough to land the 747 on a postage stamp? I suggest they have a very good shot because of the strength of the AI theme. But I think the rest of the Western countries are going to go into a recession. That's how I feel.
Well, wait a minute. What does AI have to do with the economy? Please elaborate. I mean, AI is propping up NVIDIA, it's propping up the NASDAQ, and by extension, it's propping up the rest of the S&P. But how does this benefit you and me?
It benefits because what's happening is Elon Musk is going to Dell and going to Supermicro and basically saying, I want you to build the state-of-the-art server farms for me. Right. So what we're doing now is we're going from the NVIDIA stage where they're going to be launching Blackwell in the fourth quarter of this year. And now what's going to happen is Elon Musk is going to go, I'm just using Mr. Musk as a reference point and saying, OK, we're going to go. We've got all this data. Build me a the state-of-the-art server farm that's going to basically take data and convert it into intelligence. And I would suggest if Mr. Musk is going to do this, then Mr. Bezos is going to do this, then Google's going to do this, and you're going to have a massive spend of big, massive global technology companies that have lots of cash because they understand that this is a winner-take-most game. And so that spending spree should support economic growth within the United States.
You tweeted about this, actually. You said that AI is underhyped. I think you're the first economist I talked to that has said that from a value, I don't know if it's a valuation perspective, but just from a stock market perspective, AI is being underhyped right now. What do you mean by that?
I just think we really don't know how big this is going to be. I am old enough to remember. Well, let me put it. Bill Gates basically says this is legit. This isn't the 90s where it was pet.com, right? The valuations that NVIDIA have is substantial. I mean, and it's relevant, and you know what? It's fairly valued. How big will Blackwell be? How big will Dell get? You know, what is Tesla going to do with all that data? They have a massive day in early August about robo-taxis. So what I'm trying to say in this era, so, you know, it's funny because this is Janet Yellen's husband. It's George Akerlof, right? It's called blind betting. When you're in an era of a market where you're trying to guesstimate what total addressable market is going forward, and it gets bigger and bigger and bigger, basic traditional valuation metrics don't work. So, David, we're going to have a bubble here, right? And that's normal, right? And that's okay, right? That's okay. And I would suggest to you that the secular growth lasts until the end of the decade and most likely early into next decade. But, you know, but is it overhyped? No. And I think what you get is I think a lot of people really miss the trade. And it's a very simple trade, David. When the yield curve inverts, all you do is you find the secular growth names. You know, and decades ago, it was the China trade, right? Decades back before that, it was the Japan trade. Every time the yield curve inverts, you buy the secular growth theme. I would suggest to you that AI, we are in 1985, 85. Not 95. We are that early in this theme. We have to rewire the whole global economy from a CPU-centric architecture to a GPU.
The winners are obvious. Who are the losers from this AI trend?
Any company that doesn't embrace it, they will be disintermediated. There is going to be massive disruption.
Who are the BlackBerries of tomorrow?
Oh my gosh, that's a great question. Anybody whose business model is focused solely on CPU-centric computing. How does that sound? Anybody that's in an era that is not embracing taking data and converting it into knowledge. Like this is how profound it is. You know, what we're doing is the first step was taking water, taking an atom, applying heat to it, and making it an electron. That was the first stage of the Industrial Revolution. And that electron became electricity, and we started trading electricity. And now where we are is we're taking that electron, and we're basically processing it, and we're turning it into intelligence. And the reason why I tell you about focus on Tesla, for example, David, we don't even have AI firms. Think about it, we don't really have a true AI firm. We got the picks and shovels are being defined, right? That's NVIDIA and that's Dell, right? But we don't have a true AI firm. I think Tesla will be the first true AI firm. They've got the data, right? That's how early we are in this thing.
What about auxiliary industries around this? Energy. Are you bullish on energy? Think about
yes, energy.
GPUs are going to need in terms of electricity. Yeah.
Yes, you've got so the utility play, a utility play, right? I mean, go back to the infrastructure play. Everything has to be rewired. So a company like Eaton, company like Quanta, uranium, copper. I mean, you can even talk about natural gas, right? I mean, we're going to go through this period of time where we're going to need energy. We're going to need nuclear power. We're going to need copper. We are going to have a massive rebuild in front of us. How big does it get? How stupid does it get? All I can tell you right now is what you're seeing, which is completely different in the 90s. And I echo what Gates says. Mr. Gates says is you're seeing real earnings. Right, NVIDIA went up a lot, yes, but so did its earnings. In the 90s, there were no earnings; it was clicks.
Well, the earnings went up, but the PE also skyrocketed, right? I mean, something went up more than the earnings, which is valuations.
Right, but what's interesting is if you look at I'm old school, right? So I will value some of these companies on a PEG ratio, as long as the growth rate for NVIDIA continues. That's a big question. That's a big if, right, David? It's a big if, right? As long as the PEG keeps going, if the PEG's less than 1, you buy.
How do you feel about the legacy? I'm calling them legacy. The existing big tech companies, Alphabet, Apple, they're all embracing AI in some way. Apple is actually now integrating OpenAI's AI software into iOS, right? So is there a future here for expansion, growth?
Yes, huge upgrade cycle. I'm old enough to remember in the 90s, every time Microsoft came out with the new versions of Windows, my first computer was an XT, then it was a 286 and a 386, then a 486. You had a massive upgrade cycle. So we were going to have a massive upgrade cycles in phones, in servers, in PCs, the whole shoot match. And the tech companies understand this, because if you don't do this, you end up being like a Yahoo, or like you mentioned, a research in motion, right? You either innovate or you die.
Okay. So let's sum up your market outlook thesis for us then. You tweeted that the MOVE index suggests this rally in risk assets is not over. This was a week ago you tweeted this, but earlier in the interview you said that you're expecting a stock market crash. So walk us through the discrepancy here.
My view is that if we use the 4-year presidential cycle as our guide, okay, 2026 should be a tough year where we should, since 1918, have a drawdown within that year of somewhere between 15 to 18%, and that would be normal, natural, and healthy. Okay. When I came into this year, my view was that by the end of 25, we would have get to 6,000 on the S&P. Okay. We're possibly most likely going to get to 6,000 sometime in the late fourth quarter or early first quarter of this year, late fourth quarter this year, early next year. I think we're setting ourselves up for a blow off top in 25, where the S&P is somewhere north, let's say 6,500 to close to 7,000. And then I suggest to you that we have a significant correction in 2026, which is normal, natural, and healthy. And then from there, we basically rally into the end of the decade. And I could easily see the S&P 500 north of 15,000. And that's been my call. That's been my call for about 4 years, right? And the secular bull market is because of the demographics, right? Because of the millennials, right?
What about the millennials? I'm a millennial.
If you just go back in history and you get the census data and you overlay a massive cohort.
Yeah.
And it's Modigliani's theory of life cycle that we learned in undergraduate economics, right? You find a big cohort and they go into prime family formation and savings. When you do that, you get a blow off top. You get a secular bull market.
I understand your thesis that's played out in history, but let me push back and say this time is different. What family formation shit? Have you looked around? People my age, we can't afford homes.
But David, what happens if you own Bitcoin and Bitcoin goes to $500,000? No. Think about it. It's the same thing, right? If you get and I don't mean to be facetious, right?
Sure.
But Irving Fisher, right? Business cycle. The way you get out of this debt deflation spiral is you create a paper bubble. It's there in economic theory, right? So all of a sudden you buy a half of Bitcoin and all of a sudden, Bitcoin goes to $500,000. You have enough to buy a house.
Well, let's talk about that. You bullish Bitcoin then long term?
I think Bitcoin and gold are very interesting. Yes, because I think the US dollar is going to be king dollar, but I really do think that the US treasuries have lost some of its luster in terms of store of value. So I would suggest to you that Bitcoin is going to become a traditional asset class. And because of that, managers are going to have to own it because of tracking error risk in their portfolios. So I suggest this is no different from me being in 2003 when I was on Park Avenue and we got the first presentation from Goldman about brick, and we talked about commodities, and we were a bunch of Canadians working in the States a couple of years. And if you cut your teeth in Canada, what do you know? You know rocks, trees, and water, right? But you sat there and it wasn't an asset class. No American investor owned it. There was no sell side coverage. There was no banking. And guess what? Jeremy Grantham came out and had a wonderful paper saying if you put commodities in your portfolio, you increase your Sharpe ratio, right? Well, what is Mr. Fink saying? It's an asset class. What is the CFA Institute coming out saying and telling us? Well, if you put a 3% weight in your portfolio, you increase your Sharpe ratio, right? Risk-adjusted returns. So to me, it's the same trade, right? And I think it's a store of value. I think it's gold, right? And I think the baby boomers like gold. And, on the BlackRock site, millennials are going to be driving investment taste going forward. They like ETFs, they invest in macro, and they invest in crypto.
Okay. On that note, so you're still long beta right now? Is that's your play? You're still long risk and beta?
Yes, I think, tactically speaking, if you want to raise a little bit of cash going into the election, we're seasonally strong until August. So as a strategist and an economist, our conversation is more, David, the big asset allocation trade is going to be in late 25 when it's real FOMO. And do you start, selling the rallies because the S&P is at 67, you know what I mean? And raise cash. That's going to be the bigger question moving forward.
What do you do when you see market crash signs? Are you raising cash? Are you selling? Are you shorting? Are you buying gold? Are you buying treasuries? What's your defensive play there?
Well, I think what you've got to do is you've got to realize that, in an ETF world, right, where, we have target date funds, the drawdowns are significant because of everybody buys and sells at the same time. So it's a big call. You've got to get defensive. You've got to go into bonds. You've got to short the market, and you've got to own a ton of cash. Because what will happen, David, is people will sell things that shouldn't go down because they have to, because the compliance department is tapping on your shoulder saying you need to take the leverage of your portfolio down. So what happens? You don't want to sell NVIDIA, but you sell it because that's the only thing you can sell, right? So that's the type of event that it lines up, right? Narrow breadth, inverted yield curve, people sitting there talking about a massive problem in the room, which is the fiscal problem. Policymakers saying we're going to ignore it. Wall Street saying, I've heard about this all my career and it's never going to happen. Well, David, if this thing breaks with 7% deficits and debt to GDP at 122% and Western debt at Napoleonic War levels, it's going to be epic. And we need to think about, so if you and I are talking in portfolios, we need to have conversations like we're having right now. Because the decision you're going to make in terms of allocating your portfolio, it's not going to be raising 5% cash. It's not going to do it. It's like, are you going to really get defensive? Are you going to go short the market? Are you going to completely and totally sell equities? Are you going to go max cash and buy bonds, right? How are you going to manifest it? Because you asked the big question, and these are the questions we're having at Wellington right now. What does your portfolio look like if this happens? And what do you need to see to get you to start working your way? And my suggestion to you is Trump gets into power and he puts in a cabinet and he basically gives lip service to the elephant in the room, which is the debt.
Does your cash allocation change depending on the level of the Fed funds rate or even just 10-year in general? I
think right now you're all in, right? You don't want to be in cash, right? You do
Why
not
not?
want to be in cash. Like for this short,
you're getting a free 5% on the
sure if you want to, but I still think we're at 55. I think you've got 100 points. You got 1,000 points in the S&P. Right. And I think there's going to be, so let me be clear about this, right? I mean, I honestly think we're going to get the real FOMO next year. I think you're going to just get me in. This time it's different, yada, yada, yada. And I am really concerned about the fact, I mean, my narrative would completely change if Mr. Trump was much more insightful in terms of how he was going to deal with the debt, as opposed to we're going to raise tariffs on Chinese products and we're going to basically make the tax cuts permanent, right? That just is not going to fly. Okay. That is just not going to fly.
Okay. So a lot of your investment thesis rests on that. What do the Democrats win? Would your thesis change?
Well, then the thesis is basically they've got to realize that the modern monetary theory experiment that deficits don't matter is over. Right? I mean, and if they don't change, right, if Mr. Biden gets in and they don't change, it's, as far as I'm concerned, the die is cast. And the reason is you're seeing very important people around the world sounding the warning bell, saying you cannot continue this silly investing, right? That deficits do matter. Okay. You are robbing from the young, right? If you don't fix this, the interest payments on debt plus the unfunded liabilities and Medicare and Social Security is going to cripple us. Okay. That is what we're dealing with. And it's real. And if you don't fix it, look what they did. I'm not saying the United States is Greece or Spain or Italy, but look what happened to the pigs, right? When they had to deal with their unsustainable fiscal spending, and look at the pain that had to go through, right? I am not saying it's going to happen to the United States, but it is folly to assume that the Americans can continue to spend like they did, or as Senator Kennedy would say, spend money like it's pond water. Okay? That's the risk.
Okay. Let's end it here. Great talk. We can follow you where, Jim?
Yeah, Wellington-Altus.com, Dr. J Strategy on X or Twitter, and I'm on LinkedIn. Or I'm sure, David, you and I'll talk again in a few months and to catch up on what's going on.
For sure. So catch Jim in the links down below here on this channel as well. Go to the link down below to see our last conversation. That was really good conversation as well. Thank you very much, Jim. We'll speak again soon.
Take care, David. Be safe.
And thank you for watching. Don't forget to like and subscribe.